The following episode of the Maui Chamber of Commerce's Business Matters was originally broadcast on March 25th, 2025. It's now time for the Maui Chamber of Commerce's Business Matters and your host, President of the Maui Chamber of Commerce, Pam Toompop.
Hey, aloha, Shaggy. How are you today?
Good. How are you, Pam? I've always
I'm
wanted to do the
great.
intro because Gary does all these great intros and he gets the big voice. So this is my time.
Yes.
I usually do only the podcast, so this is the time that I get to go, here's Pam.
Well, you did that excellently. Thank you so much.
You're welcome.
And we thank you for all that you do to get our podcast out in the internet and out where people can see it in a variety of ways. So we truly appreciate you, Shaggy.
Thanks so much.
Well, welcome everybody to Business Matters. Today we are going to speak with our friend and great economist, Paul Brewbaker, about the economic health and well-being of our economy and discuss what came out of some of the recent legislative actions that could impact our progress, both, in different ways. We'll talk about that. And then we're going to talk about BizMix Maui, our big fundraising event coming up this Saturday. And we'll share more about some of the great things. It's getting pretty close to selling out, but we do have some tickets available on a first-come, first-served basis. So we'll talk a little bit more about that at the end of the show. But let me first thank Paul Brewbaker, who is returning this morning. He is the principal of TZ Economics, one of Hawaii's most respected economists with decades of experience analyzing economic trends, market dynamics, and policy impacts. He is a graduate of Stanford University, and Paul did his graduate work at the University of Wisconsin and received his PhD in economics from the University of Hawaii. Over the years, he has lectured extensively on economic theory and applied courses at both Wisconsin and Hawaii campuses. He is a member of the American Economic Association, the American Finance Association, and the National Association for Business Economics, from which he holds the Certified Business Economist designation. Paul has been a key voice in explaining how global and local economic factors influence both businesses and communities in Hawaii. Previously serving for 25 years as the chief economist at Bank of Hawaii, his deep understanding of the forces driving economic change in the islands has always been welcome. And we are always glad to have you back as a returning guest. Aloha, Paul, and how are you?
Fine, thanks, Pam. Aloha. And I need to correct something. I worked at Bank of Hawaii for 25 years, but I wasn't chief economist for all.
What was your title?
Most of my career there. Well, I climbed the corporate ladder, so started out associate economist, and it was economist, and then it was chief economist, and then it was last economist.
Yes, well, I appreciate that. So, yeah, as you say, we move up and our position changes over time. So thank you for that correction. So glad to have you on, Paul, and I really appreciate your calling in to be with us from Denver, Colorado. That is awesome. And, we just wanted to talk a little bit about, where we're at and some of the changes we're seeing and what it's going to mean for Hawaii and for Maui. But let's start with some of the changes that came up at the last legislative session at the State of Hawaii legislature that will impact us economically in the near future.
What do you have in mind?
Well, I'm just wondering, there was so much movement on housing. There was so much movement on funds for Lahaina and different areas where, we got to see a lot of money sort of being planned and moving in our direction for some emergency preparedness things. But we're wondering your thoughts on what you saw coming out of the session that you think will impact us long term, and maybe some of the things, I don't know if you're tracking this year's legislative session, but some of the things that you're seeing either at a state or federal level that you think will have significant impacts for Hawaii.
Wow, we could talk for a long time about the catastrophe at the federal level, but maybe let's defer that just for a second. The two things that stood out in my mind last year, and there were others, of course, but I think the tax cuts to which the state pre-committed, and along with some other fiscal initiatives, state fiscal initiatives, I think make a big change. I won't go through the details. Some of it involved increasing the standard deduction, and some of it involved tax rates. Tax rate growth. It was a relatively expansive approach phased in beginning. Is it this year already? But
yeah.
pre-committing substantial amounts of future state revenue that otherwise might have accrued, and at a time when the state felt that its fiscal position was relatively strong. Some of us who were a little more skeptical of that were concerned that the so-called surplus, or the cash carryover, was left over from the pandemic relief that hadn't been spent, and maybe wasn't as dependable on a forward-looking basis. That is to say, wasn't originating organically through the state's economic activity and growth, and therefore might not be available in the future. Nevertheless, the legislature felt it was in a position to make fairly generous changes, and as a whole, most of them were rooted in taking into account the fact that wages and salaries, as they increase over time with productivity growth, tend to bump people into higher tax brackets. And as inflation raises living costs, it leaves the value of deductions for some taxpayers eroded as a consequence of the cumulative effects of inflation. Another concern, however, that I've had more recently is that for about the last, maybe a couple of fiscal years, certainly the last year to 18 months, maybe going back into the fall of 2023 already, and partly because of the higher inflation that we in Hawaii and the nation had in 2022 and 23, and then again, a second wave of inflation associated with the high rents that sources of support for disaster relief following the Maui wildfires were willing to pay. And ironically, bidding up housing costs. And that showed up in Hawaii's inflation rate last year as well, temporarily, but nevertheless in a meaningful, quantitatively significant manner, as a passing inflation surge that rose and then fell, a secondary surge that was not shared by the U.S. as a whole. And now both Hawaii and U.S. inflation rates slowly are settling below the 3% mark, headed towards maybe 2.5% by the end of this year, currently in the neighborhood of 2.8 to 3%. And that subsidence is a product of the monetary policy, the high interest rates that kind of shut down the housing market the last several years, but nonetheless have had their intended effect. Because of that inflation surge and then Hawaii's secondary surge, the value of the standard deduction and whatnot in the state's tax code was really out of alignment, and so the state did some work on that. But at the same time, it also meant that state tax revenues were also eroded in terms of their real purchasing power. You see what I mean? And so,
yes.
From a relatively steady real or inflation-adjusted rate of growth during the decade of the 20-teens, and then largely, even though interrupted by the onset of pandemic, largely continuing in maybe 2021 and 2022 with the revenge travel surge and and the impact of federal fiscal stimuli and the low interest rates preceded, the supply chain inflation and the Fed's reversal of monetary policy in 2022 and 2023. That relatively steady growth in real estate general fund revenues, or primarily tax revenues in cases that I've seen the numbers for, pretty much stopped. And revenues adjusted for inflation pretty much went sideways for the last year or two. So it's just something that we're all going to want to watch as the tax cuts roll out, given that the so-called surplus has largely dissipated or been committed to do things that were, on the calendar. And at the same time, the underlying, as I call it, organic growth of real estate tax revenue has not sustained itself in the last year or two.
Yeah, very good point. That is going to be something to watch, and we'll see how it goes. I think, as people see the tax cuts this year, I think particularly on Maui, but across the state, I think people will be glad to see them. But then again, we're worried about a funding crunch. And you mentioned...
Yeah. The question is whether... I'm not sure what the state's working on this session. We're only halfway through, and we're right at the point where we really start to get a better focus of that. But they may not have the kind of fiscal wherewithal they might have thought they were going to have, given their pre-commitment to the tax cuts, and given, as I say, that the recent inflation has actually undermined some of the growth of real tax receipts.
Yeah. Well, as you mentioned earlier, and we could go on for days about it, but let's take a stab. As we're looking at this, and we're looking at the tax credits that are being offered, and we're looking at how we sustain our state tax revenue and the budget that they need to put forward, and in times that are a huge challenge, many, of course, are very concerned about what's happening at the national level, and how we see that impacting our state overall, and of course if you have any unique things on Maui County. And then one of the key things in that, as a follow-on that I'd like us to discuss, is the tariffs. And any thoughts you have, Canadians are a big market for us as part of our visitor industry here,
Sure.
and even Mufi Hanum has recently acknowledged that. So if you want to address the tariffs and what's going on with the Canadian market.
Sure. I think it's important to remember that because of the concern I already expressed about, maybe the underlying strength of Hawaii's economic expansion or post-pandemic recovery, while it's been parallel to the U.S. recovery, it hasn't ever caught Hawaii back up to the path it was on pre-pandemic, whereas the U.S. economy did return to its pre-pandemic trajectory. So the fact that Hawaii, having lost about 10% of GDP per capita, as a legacy of the pandemic relative, so Hawaii and U.S. per capita GDP were about the same back in 2017. Today, per capita GDP in Hawaii is about 10% lower after inflation. And Hawaii is growing at the same rate as the U.S., 1.5% to 2%. But that just means that the 10% loss of per capita GDP remains baked in. It won't disappear as long as growth only matches the national average rather than exceeding it. And because of that, Hawaii is in a little bit more vulnerable position. It proved as a regional economy for a variety of reasons, but the drop in travel and the changes associated with the pandemic itself, and then changes in the pattern of travel preferences. So I mentioned a second ago the revenge travel surge. There was a surge following the fiscal stimuli, following the widespread adoption of COVID vaccines. following the sense of relief and reopening that began to take hold, particularly from 2022 to 2023 before the wildfires on Maui.
Right.
In that 12, maybe 18 months period, there was a surge in domestic travel to Hawaii, which unfortunately was already petering out before the wildfires. And then the wildfires caused a complete shift in perception of Hawaii as a destination, Maui in particular, but Hawaii generally, leaving us in an adverse position. And again, to this point I raised a second ago about resilience, showing again a vulnerability to a kind of shock, both in the case of the pandemic and then subsequently the natural disaster of the wildfires, from which Hawaii really couldn't mount a complete recovery, only a partial recovery. And,
right.
90% recovery is still 90%. So on top of that, the yen-dollar exchange rate has been in such a position that Hawaii has become a very expensive destination, maybe twice as expensive when you take into account the depreciation of the yen and combine that with the increase in Hawaii hotel room rates. The total cost of lodging, for example, for a Japanese visitor today is probably twice as high as it was 5 or 6 years ago or pre-pandemic. So on top of that now, we have this pattern of global revulsion at some of the geopolitical postures that the U.S., the new presidential administration, unilaterally is taking without discussion with its global trading partners or its global security partners, and seeming to go its own way is inducing former trading partners, security partners, former allies to part company. And so we read and we are beginning to see in the data, as he suggested, that in addition to what was already a failed tourism recovery overall, a new chapter in Canadian visitor cancellations, and similarly, a pattern among Canadian investors in which they are seeking to exit U.S. financial markets, U.S. real estate markets, and of course, that kind of selling, other things equal, is going to put more downward pressure on some asset prices than already has occurred because of the financial markets' uneasiness about the chaotic nature of the new administration's policy proposals, its inability to implement for example, a tariff plan that doesn't involve flip-flopping and reversal and capricious shifts from one day to the other. So the uncertainty as a whole is not just weighing on financial markets, but it's going to be weighing on investors in Hawaii real estate. And I believe as we begin to get the data, to get a clear picture of the winter travel data to Hawaii, we should expect to see some weakness in these other segments of foreign travel to Hawaii. So it's Hawaii's had an uphill climb, and that's going to be more challenging. Now the tariffs themselves, should they be implemented on April 2nd, as the new president has suggested, or maybe he's changed his mind, or I don't know, call me tomorrow and we'll see what happens in the next 24 hours. The new tariffs, because they not just raise the prices of merchandise and services that people in Hawaii, that Americans in general acquire from abroad, but also the costs of all the intermediate goods, the materials, the building blocks of industrial production in America. Those tariffs, such as they end up being, and we just don't know, will inevitably raise the costs both for the final consumer, so in terms of the end product prices, but as well raise the cost in the so-called supply chain. So making even the domestically produced merchandise and services more expensive than they otherwise would have been. That's basically the same thing we saw when the pandemic shut down the global supply chain or impaired the global supply chain. Exactly the same thing. So we should be wary of additional inflation risk appearing in the future. The Federal Reserve, the Monetary Authority, last week articulated the same kind of concern and a wait and see sort of a posture. The Fed chair talked about the challenge separating the signal from the noise. It's hard to tell what's actually about to happen when the cacophony of sort of incoherent statements about policy is making it difficult to pin anything down. So I would say that a prudent, and of course all of that leads investors writ large, not just investors from Canada in Maui condominiums, let's say, but investors in general tend to be risk averse and tend to pull back under those circumstances, as we have seen domestic consumers already begin to do, both in terms of their actual consumption, not so much their spending yet, as their consumer attitudes and expectations. So, it's a little bit of a warning light. We ought to keep our eyes on it. The problem with the kind of shock we're seeing is that when combined with various efforts to reduce the size of the federal government, you have the combination of an adverse aggregate supply shock like the supply chain disruptions of several years ago, and the reverse of the fiscal stimuli of a couple of years ago. So, right, the opposite of an increase in federal expenditure, we are seeing what's intended to be, straight up intentional decrease in federal expenditure. So the opposite of a fiscal stimulus, and that reduces aggregate demand. Unambiguously, the economy will not be as large as it would otherwise have been, meaning it could be smaller, and the economy will certainly not grow as fast as it might otherwise have done. And that was reflected in the downshift of the Federal Reserve Open Market Committee's survey of economic projections, which lowered the GDP growth forecast in 2025 from an expectation last December of 2.1% to an expectation last week of 1.7%. And some estimates that are actually negative, so-called real-time or nowcasting estimates, are pointing to the possibility of an absolute decrease in GDP already underway in the quarter that's about to end. So a lot of risk, a lot of things to pay attention to for businesses, and maybe a good time to just think about how a business might respond to unexpected adverse surprises.
Yes. Yes. Do you have any, on that note, do you have any areas that you think that they should plan forward with right now? How ways that they can pivot? And again, we're talking broadly, so I know that impacts different industries differently in terms of how they would plan for these changes. But what
Sure.
is there some general comments that you'd make?
I guess the good news would be that if I'm trying to get my phone to work here, that if the why is my phone opening up the way I want it to? If the economy does go into recession, the Federal Reserve might find itself, which we had already anticipated, might lower interest rates perhaps by another 50 to 100 basis points this year.
Well, Paul and I were just talking about some of the impacts that we're seeing, both on policy at the federal level and of course, some of the challenges that we're seeing as we look to sustain our state and move forward, one of the bright spots might be, and we hope so, that we might see the Federal Reserve lowering interest rates, and so that's something we want businesses to keep an eye on, and not just businesses, but everybody, because housing is one of our top priorities, and interest rates have been up, which makes it very challenging for many people to be able to afford the financing for getting into a new home. So let's keep an eye on that. But we also want to talk about, Paul's been involved in, and as have we and many in our community, discussing the STR issues or STVR issues, as many people are now calling it, and that is short-term vacation rentals. And we were also talking a little bit about last year's legislative session. So, Paul, let's talk a little bit about Senate Bill 2919.
Yeah, first you're going to have to clarify. I'm not keeping up. So, soprano, tenor, bass, and renegade, STBR. What's the B?
Oh no, STVR.
That's soprano,
like
alto,
victory.
tenor, bass.
Alto, tenor. Oh, so alto. S as in Sam.
Soprano,
T
tenor, vegan, renegade. I don't understand
Vegan
the
renegade,
V.
yes. STVR, vegan renegade, yes. So short-term vacation rentals.
As opposed to a short-term non-vacation rental?
Well, we had TVRs, which were transient vacation rentals, and we have B&Bs, and now recently we've...
yes. The famous transient vacation. I remember that. As opposed to my permanent vacation. I mean, I don't know. I'm making fun of it, but it is kind of ridiculous, right? In the first place,
we're talking about many cases the same thing, right? But now we've got a longer acronym.
Housing and lodging are not binary. They're a continuum on the 0-1 interval, right? So, according to opponents of SBVTR whatever squared, Mary and Joseph couldn't stay in the manger because there was no room for them at the Maui Inn. I mean, it's gotten kind of ridiculous. And what's ironic is Senate Bill 2919, as I understood it, didn't actually do anything that the counties couldn't already do. Like, they didn't need Governor Green's permission to regulate rentals. But, the legislature passed the bill. Governor signed it on May 3rd. And instructively, Maui Strong, as we call them, SHTRONG, Maui Strong upstaged the governor at the bill signing and celebrated the fact that now they could end their occupation of Ka'anapali Beach. And it's like, what the F does occupying Ka'anapali Beach have to do with? I mean, you can just build housing, and that's the crazy thing about all of this, is because it doesn't have anything to do with housing. It has everything to do with anti-tourism denialism. So people don't want tourists, and some people don't want tourists, and some people don't want Haleibukas buying real estate. And that's just straight up a fact. They don't want tourism, or they want less tourism, and they don't want offshore investors, or they want fewer offshore investors. And, maybe because they're Haole or whatever. And the fact of the matter is, you can build housing. About 50 years ago, 1.5 century ago, without computers, Maui built 3,000 housing units every year after year. So it's been done. Maui built more than all the houses that were destroyed in the Lahaina wildfire in a year, 50 years ago. So it's been done. Whether a 50-year-old condominium in Kihei, like a studio apartment with a kitchenette that clearly was intended for, clearly was not intended for permanent residential occupancy, whether that now should be foisted upon some, local household as an excuse to not build them housing is a completely separate question from the question of how do you manage the destination, how do you mitigate the pressures of congestion, cultural and natural resource degradation. That's a destination management question, and those in turn have nothing to do with whether it's possible to build more houses on Maui. And not only is it possible, it's been done. It used to be done with regularity. So I don't even understand how we got here. The last I heard, it sounded like the mayor didn't even want to bring it up in the State of the County speech, which is kind of odd. I mean, surely he's been thinking about it, at least since the wildfire. But more recently, I'm getting the vibe that people are starting to realize that you don't have to forego billions of dollars in tourism receipts and tens of thousands of Maui jobs when you could just build houses. And it's totally win-win. You manage the destination and you figure out how to build houses. So that I'm hoping that people recognize you don't have to throw out tourism to do a better job of managing it, and you don't have to deny people access to larger numbers of housing units. By the way, new housing units are not affordable housing units. Old housing units are affordable. So the faster you build the new units, the more affordable the older ones are going to end up being, and the sooner they're going to end up being affordable.
Right. Yeah.
It sounds like Maui may be moving in that logical direction eventually anyway.
Well, you bring up a good point, and it's a point that's not well discussed here, actually. And my daughter lived in Kansas City, Missouri, and there was a lot of gentrification going on over there, and a lot of refurbishment of, they were building new, and they were continuing to build new. But a lot of the refurbishment they were doing in some of the older homes was, still creating a very nice housing product, but at a more affordable rate than the new housing products coming out.
The key pretty clearly.
Go ahead.
Go ahead. I'm sorry. Well, I was going to say the key pretty clearly. Yeah. Go ahead, Pam. It's the radio.
Oh, no. Go ahead, Paul. You were saying it seems pretty clearly.
Well, it seems pretty clear that Maui's going to have a certain small number of conurbations, the Kahului-Wailuku conurbation being the most prominent, the South Maui conurbation. And then whatever happens in West Maui, it needs to be stitched together by extending the Lahaina bypass, and there's some infrastructure issues. But you could just build lots of medium density, 4 to 6 story multifamily housing around the periphery of the Kahului-Wailuku conurbation, and you probably solve. I mean, if you're going to build large numbers of units, which is ultimately the solution, because you don't forego any tourism, so you have your cake and you eat it too. Kahului-Wailuku conurbation, as I say, it's kind of one city, would be the natural place to do it. And whether you radially expand the footprint of the, of urban form across the isthmus or not is a debatable question. But if you do it with density, and by the way, you're not doing people in search of affordable housing any favor by building them single-family homes, right? Single-family homes are not affordable homes. So you got to get real and get Stanford Car in there and start popping out several thousand new housing units every year. Evil.
Yeah.
That's the solution.
Yeah, and as you know, and as we've long discussed, I mean, it's just been a crisis that has existed for a number of years, and as you point out, it's been done before. We've done it before. I mean, it's been done on Maui. And one of the models. Oh, go ahead.
Well, I understand that the political challenge is that some people don't want tourism and some people don't want housing to be built. And you put those two groups together, and sometimes they're a majority. And they may be a majority right now. And if they are a majority, right, if you take the people who don't want tourism, you take the people who don't want houses built on Maui, and you put them together, and they're a majority, then my message to the people who are looking for affordable housing is leave Maui. They don't want you there. So,
yeah.
I mean, that's...
And we're fighting to protect our local residents who want to stay.
No way around that,
are
right?
desperately looking for housing.
Either build housing for them, or because if you take away a third of the units that are in short-term, transient, vacation, whatever you want to call them, if you take away the third of the lodging units on Maui, you take away up to a third of the tourism on Maui, which means you take away up to a third of the tourism jobs. I mean, it's literally that simple. Tourism's a third of the economy. Tourism's 30% of the Maui economy, probably approximately the same share of jobs, directly and indirectly related to it. So take away 10%, right? One third of is around, take one third of 30% is 10%. Take away 10% of the jobs on top of the 10% of Maui jobs that disappeared since 2019. 5,000 from the pandemic and 5,000 from the wildfire. Now take away another 10,000 and then build houses, or don't build houses. Let the remaining people move into abandoned, condos in Napili. And I mean, the only problem is they won't have jobs, so they can't pay their rent. I mean, it's like, why go down? Why spiral downward into oblivion when you could do tourism and build houses?
Yeah, it was a very aggressive proposal without a well-thought study as we look at the impacts. And it's becoming very emotional.
How could you get rid of how could you extinguish one third of the lodging units on Maui without reducing tourism on Maui, and therefore without losing jobs on Maui? What are they going to do? Go work in agriculture? So right off the top, it was a job killer to blow up the Minatoya list. But like I say, I mean, it's been done. Now, how you do it matters, right? If you make urban form efficient, right? If you build the infrastructure so that people are aggregated or agglomerated close to employment centers with the transportation and the utility infrastructure that, because it's nearby, is low cost to deploy, then you're doing people a favor by providing them with housing opportunity that's close to the centers of employment. That's not going to happen in resorts, because resorts are never going to be inexpensive. But that's 30% of the economy is tourism. I'm talking about the other 70%. So at least something for them.
Yeah, no, very true, Paul. And there were times where we, many years ago, built in condominiums where people could come in at a low rate and actually have ownership and build equity in their condominium. And, that was Harbor Light years ago. So we have other models.
The thing about the concern about high-end offshore investors, it's so misplaced, because those guys can afford to buy anything they want, right? The rich people can just go buy whatever they want. So what you see is what they're willing to buy, right? You don't need to build anything for those guys, because they can just buy whatever they want. And yeah, sure, they can pay to get built whatever they want. But what's not being built are the middle part of the, if you look at the housing density function or the valuation densities, you're not building in the middle because the system's set up so that you cross-subsidize low-end units with high-end units, and that's all that gets built. High-end units and cross-subsidize some low-end units, and it's the middle that needs to be built out. If you build, in the sweet spot in the middle where most people live, then it inevitably pushes the valuation distribution right in the zone where you're most concerned about those valuations pushing upward because of the nature of the offshore demand that's already extant. So, Maui planners, that's what planners do, right? They figure this stuff out. So. Medium density, urban core,
that's very true.
Proximity is mobility, right? That's I look at some of that vacant land, south of Home Depot and
there's a lot of land
up
there.
Around Punene Mill area, there's a lot of land.
Yeah, there's a lot of land there.
A lot of multifamily community in there, and it'd be close enough to the urban core of Kahului Wailuku, that it would make sense to expand public transportation options, and it would also make sense because you'd be building residential density in an urban environment from which it's more efficient to transport via public transport the workers that do work in the resorts. Right? It's all about scale.
True.
Scale up the urban core, and then you'll make things like utilities, water, sewage infrastructure, and transportation infrastructure more efficient or less costly to deploy because the cost per user would be lower because they're all crammed, I shouldn't say crammed together because they're living vibrant, dense communities. Live, work, play, right? All that stuff that planners talk about.
Absolutely.
The new urbanism.
Well, Paul, on that note, we've got to go, but I so appreciate you, and I wholeheartedly agree. And we keep talking about it, but we need to get there, and we need to use that as a tool right now. But thank you so much for calling in today from Colorado and for joining us. We appreciate your insights, and as always, we'd love to have you on again soon.
Anytime, Pam. Always fun to confront these issues and think through them with you.
Oh, I love it as well. Thank you, Paul. Have a great week there, and look forward to connecting again soon.
Okay. Aloha.
Aloha. All right. Well, it's always great to hear Paul's thoughts and well-researched data and learn from that. And I think we've got a lot to consider from all that he shared on many different levels in terms of really watching what's happening as businesses need to plan. There's so much uncertainty. Everybody's really trying to stay tuned and be planning forward. And where I know we're all watching the nightly news and looking at changes every day. But on a happy note, we do want to share, it's also a time for celebration. Things have been challenging, and we know it, but everybody is working hard. They're looking at how to recover, and it's so important to network and come together, and that's what our Business Maui annual event is about. This year's theme is taking us on a throwback. It's Vintage Aloha, it's a fundraiser this Saturday, March 29th at the Grand Wailea from 6 to 9:30 p.m. We're going back to the celebration of the 1950s and 1960s of Hawaiiana, Trans-Pacific travel, the Pan Am era. I'm so excited to share. We have such a great menu that is going to be by the chefs of Grand Wailea, Chef Mark McDowell of 62 Market, and Patelli House. But Patelli House will be serving Kalua pig. So we're thrilled to be doing that, and it's just going to be such a fun event. In addition to, it's small plates, but believe me, you will have plenty of food to enjoy, and then great music and entertainment. So we've got Joe Chi, who is going to be doing acoustic-style performances of vintage Hawaiian music. We've got a spotlight photo booth to capture the classic looks. We encourage everybody to to dress in vintage aloha if you have it, or just your best aloha outfits. And we'll take pictures of those memorable moments. We've got specialty cocktails, local beer, and seltzer from our alcohol sponsor, Maui Brewing Company. And then after the great dinner menu, we're going to have a phenomenal hula halau. It's Kanui Heli that is going to take guests on a trip back in time. And so we're going to have a great little hula performance, followed by our headliner and local favorite, Nuff Said. So this is going to be a great time. We just want to say mahalo to our sponsors, our Golden Aloha sponsor, Alpha Inc., our Trans-Pacific Trailblazer sponsor, Ainalani Pacific, our Vintage Voyager sponsors, Airbnb, Aloha International Employment, HC&D, and Westpac Wealth Partners, our Island Explorers sponsors, Hawaii State Federal Credit Union, Lehua Builders, Wow Sushi, TS Restaurants, and Goodfellow Brothers and Pacific Rim Land. Our Jet Setter sponsors, 5A Rent-A-Space, First Hawaiian Bank, Hawaiian Electric Company, HMSA, Joseph D. Pluto Realty, Matson, Maui Grown Remedies, Hawaii Maui Health, State Farm Agency of Kit Okazaki, and Zippies, and our media sponsors, Encore and Pacific Media Group. Tickets are still available, but limited, so I encourage you to call in tomorrow, today, Tuesday, tomorrow, Wednesday. We may still have something available on Thursday, but that's debatable, so we want to have everybody come in and join us. And you can find out all the information at mauichamber.com. And beyond the fun of attending business, you can also know that your contributions through ticket sales and sponsorships go to a great cause. They support not only does the Signature Fundraiser support and benefit the work of the Maui Chamber of Commerce, it is dedicated to supporting our economic recovery initiatives, small business programs, educational programs, and business support services, which are vital to the continued growth and success of our Maui business community. And after the wildfires, we saw the need and inquiries and requests come in for the Chamber. Our work has gone up by 30%. And during this time, when businesses are hurting and families are struggling, and there's so many things on the horizon that are creating uncertainty and great change, we are working with those in need. Whether you're a Chamber member or not, if you're a business in need of help, let us help you. Call us at the Maui Chamber of Commerce. Let us work with you and help see how we can work with your business and look at ways to help you grow or pivot, whatever you may need. And in the meantime, we are also working. We help so many who are struggling with the SBA loan program, the EIDL loan program, still trying to work to help get a lot of EIDL loans through that were stuck in the system, still trying to help everybody who's in need. So this is a critical time to come together, and it's also a time of great fun. And it's also a time of meeting people, well, maybe seeing old friends and business associates, vendors and suppliers and others that you haven't seen in a long time, or making great new connections that will benefit your business. So don't miss an opportunity to join us for BizMix this year. Visit Maui Chamber of Commerce. Visit MauiChamber.com to get your tickets and visit us online. And to all of you, we wish you blessings and aloha for a beautiful Maui week. And we hope you'll join in next Tuesday, same time, same place at KAOI. Aloha.